Hello everyone, this is Matthew Frailey, founder of BreakpointTrades.com. First off, I hope everyone has had a wonderful weekend so far. It is currently January 5th, midday Sunday. By the way, it's quite cold here. I know it is across a lot of the US. It's currently snowing and sleeting. Kids are outside playing. Anyway, again, hope everyone had a wonderful weekend. This is my extensive technical analysis review of the markets, weekend edition. If you happen to be new to Breakpoint Trades, these weekend newsletters in particular tend to be quite comprehensive, anywhere from 40 to 50 minutes, 100 charts or so. We cover everything extensively. These are not for you guys who have short attention spans who watch TikTok all day. This is for those of you who really want to get into technical analysis, get into the charts, into the weeds, and learn things. We don't dumb it down just to make it shorter. We cover what needs to be covered. Again, my name is Matthew Frailey. I founded BreakpointTrades.com 21 years ago in 2003, which is amazing to think about. We provide the best technical analysis on the planet, amazing mechanical trading systems. We have dozens of these mechanical trading systems, which we share trade notifications to our subscribers. So if you're just a YouTube subscriber, you should really consider subscribing. You can get access to 5 of our weekend newsletters, dozens of actionable trade ideas, dozens of system trades, you name it. Our best subscription is a 6-month subscription. So again, check us out. If you're just following us on YouTube, you're missing so much if that's all you're looking at. Okay, so let's get back at it here. Again, this is the weekend newsletter. It's divided into 6 major sections. Like I said, we got a lot of charts to cover here, guys. This, by the way, is my second newsletter of 2025. Looking forward to a good year. I have some thoughts, macro thoughts on what I think could happen. But again, this newsletter here, it's divided into 6 sections. First off, we have our opening statement. We're going to talk a little bit about some of our systems, our mean reversion systems, KISS systems. Then we're going to move down to the general market indexes. We always do a top-down approach from monthly, weekly, daily to intraday charts, show you what we're seeing. We're also going to look at some of the large cap tech stocks, which still continue to hold up very well. So that's one positive for the market. We'll also look at a few market indicators like the VIX, some breadth indicators. We're also going to look at the bond market, the 10-year treasury yield, and the yield curve. We'll look at some of the major sectors, show you what things look like under the surface. We're also going to look at some world markets. We'll look at the US dollar, Bitcoin, commodities, precious metals, GDX, the mining stocks, and we're going to look at a few trade ideas. All right, now as far as the market, like I said, first off, let's start with the trends. Long-term trend, obviously, is still up, whereas bull market still. Intermediate trend is still up. Short term, we've had a small correction so far since early December. Honestly, I could see it going either way here. I can see positives on the market that suggest a new high here. I could see things that could suggest another low where this correction deepens or goes sideways longer. So, you know, it's a little tricky here, but hey, it is what it is. I'll point out the important technical levels for you and also give you some actionable ideas. All right. Like I said, the market has been correcting since early December. All right. We didn't have the Santa Claus rally. It was essentially a dud. All right. We warned ahead of time that that rally would fail at the previous breakdown area, which it did exactly at S&P 500 cash 60.50. Okay. Traders are now focused on the first 5 trading days of January. If they're up, that tends to bode well for the year. I don't put a lot of credence in that. I mean, it's 5 days. I think what's more important is if January on a whole is up. But I am expecting more volatility this year, okay, than last year. For the week, the Dow, S&P, NASDAQ lost about between 0.5 to 0.6%, while the Russell outperformed. It was up 0.9%. Again, like I said, guys, it's a bit tricky here. I could see it going either way. I could see positives. I can see negatives. Some positives, the large cap tech stocks, Amazon, Meta, Microsoft, Nvidia, they're all holding up extremely well. So that's a positive. The market is extremely concentrated. 10 stocks now represent 36% of the S&P 500 on a weighting basis. That's just amazing. That is not healthy long term. You need to see these other sectors start coming into play. A chart I'm going to show you below is the S&P 500 60-minute chart. There's a Fibonacci cluster at 59.66. That's an important area. There's also some unfilled gaps both to the upside and the downside that could act as magnets. Now, for the bulls, any pullback right here needs to form a higher low and stay above that recent double bottom support of 58.30. Okay, if we break that, then this correction is going deeper in this deeper zigzag pattern. Okay, so we'll see, guys. If it does that, then we could look at this larger fourth wave that we've been showing on the weekly. But if we can hold here, we could go back to the highs. So we're going to view a bunch of the market sectors. A lot of them have been hammered. They're quite oversold at this point. The bond market, the 10-year treasury yield still remains very strong, and that needs to weaken soon because that could be a problem if that doesn't start to weaken. Okay, commodities, crude oil finally broke out of its coil last week. DBA remains strong. On the flip side, copper is very weak, possibly showing some concerns of a world recession coming, which I think is coming, guys. Based on our yield curve, was the longest inverted in history. You've always had a recession after that. So I think it's coming regardless. I don't care who's in the White House. Trump's in the White House. I don't care, if I got in the White House, my dog get in the White House. A recession's coming, guys, sometime. So Trump's going to have to deal with that. It's just part of the cycle. Things goes in cycles. Precious metals, gold has been in a correction since late October, which we favored. It's currently in a coil. There's the three options still remain valid. With a shallow correction would be true if it remains in this coil. If it breaks down, though, we could be seeing that deeper zigzag, maybe to the 200-day moving average. But long term, guys, I'm very bullish on precious metals. Crypto hit that 100,000 mark, and I said don't chase it there. It did exceed it a little bit, but it pulled back after. It's essentially following the general market, guys. Now, because it's the new year, let's make some macro predictions. So one thing we could see this year perhaps is commodities outperform the S&P via the CRB SPY ratio that I've been showing, or at least part of the year, so we'll see. I'm interested in energy stocks for fundamental plays, and they're quite oversold. I've been scaling into some of those like Oxy and CVX. Precious metals are in a bull market. They've been in a fourth wave correction, so once this is complete, I'm looking for new all-time highs. Like I said, I still think a recession is inevitable because of the yield curve was inverted for the longest in history. I think we're also going to see more volatility in 2025, and we'll see more activity from our mean reversion systems. They like volatility. Okay, one of my long-term fundamental plays, AZ Customate, which we did a webinar months ago. That thing is more than tripled. I'm hoping to see it had a good last 2024, and I'm hoping to see a great 2025 there as their business continues to expand. So I still hold a really nice position in that long-term position. All right. News items this week. We got a lot of docs, a lot of things on the doc. PMI on Monday. I'm not going to list all these. FOMC minutes on Wednesday. The jobs report, which is typically the first Friday of the month, is now this Friday. So it wasn't last Friday. It is this Friday. Next, first chart below, item number 2. So here's a 60-minute chart of the S&P. So again, just showing this first before we get into the other things. So like I said, we had in December, mid-December, we broke down from that little shelf support around 60.40 to 60.50, right? We had a big move down there. We had some divergence show up on the RSI. We were looking for a bounce, and we got it. We said that bounce would fail at the previous breakdown area, which is exactly what it did. You see that? Got right into that supply zone, resistance zone, and failed. By the way, this was almost a perfect one-to-one symmetry bounce. First rally off the low was 147 points. Then you had a pullback. The next rally was 149. So that's 2 points difference. That is close enough for government work. All right, so this is a simple A, B, C up. Then we pulled back, had a double bottom, all right, moved up. There's now what we're looking at right now, there's a fib cluster here at 59.66. That's an important area, okay? We'll see what happens there. Now, if we pull back, the bulls need to form a higher low, okay? If they don't, then we're looking for, much lower prices, 5,700 maybe down in this range. But we'll see if it can form a higher low. Notice there's a couple open gaps as well that could act as magnets. So we'll see what happens this week, guys. And let's go and move on. Just following up on some of our systems. So this image, item number 3, shows you some of our recent mean reversion system trades. We have 21 of these, 22 of these systems that we run across SPY and ES futures. And here's some of the recent examples that took trades in late December. Amazing trades here. Look at these nice trades. They bought that first nice decline. They sold that rally into resistance, all making profits. I sent out trade notifications to these. So anyone who did these trades could have made thousands of dollars, paid for the website subscription for many years over. So they're all in cash. In fact, one of them was trying to trigger last Thursday, which I wish it would have. We had a nice rally on Friday, but they're all in cash at the moment. And here's what ended up happening for 2024 for the mean reversion SPY and ES systems. For the SPY ETF, there ended up being 29 total trades, and really almost every trade was up. The one that was down was actually an error that I sent out that actually didn't trigger, that I took back the next day. Lost a measly $51, big deal. So all these others have made nice gains. And here's the mean reversion systems for the ES futures, which triggered 35 total trades. Okay, a few losers in here, but very nice gains. Made $28,860 for the year if you follow these modest sizes. We issued trades on the MES contract. That's the micro contract. It's 1/10 the size of ES. So it's, you don't need a huge account to do these. And futures have tax benefits, but these did well. And like I said in my comments, should we have more volatility in 2025, which I think we will, I think we're going to see a lot more trades on the mean reversion systems this year, maybe double the amount of trades because they like volatility. Okay, let's go and get back to the general market newsletter here. So item number 6 shows the index sector table, what transpired last week and on Friday. So Friday had a nice rally, as you can see, for the major indexes for most of the sectors. For the week, the Russell ended up about 0.9%, while the other indexes were down 0.5 to 0.6%. Like I said, Friday was a good rally day, but for the week, the sectors, we followed 21 of them here, they were mixed. I'd say roughly half were up, half were down. Sectors that did really great last week was energy, XLE, oil services. You could see up 3.4 to 5.4% respectively. Those are the strongest sectors. Materials, industrials, retail, those are some of the weaker sectors. Currencies, US dollar was down on Friday, but was up 1.1% for the week. So it continues to be very strong. That could be an issue too, guys, if we don't see that start to reverse. That's also going to start to hurt potentially some of these companies, large cap companies that sell overseas because of that strong dollar. Cryptocurrencies, it ended up closing up 5% for the week, so it's now back to 98,000. Bitcoin, to me, is more of a leveraged play on the market. When the market corrects, Bitcoin does. When the market rallies, Bitcoin tends to rally. So to me, it's not really a hedge on the market. It tends to follow the market, just more volatile. And as far as commodities here, the DBC, that's the index, was up 1.9%, largely due to crude oil up 5.5%. Natural gas did lose 1%. So it was up big last week, so it gave some of that back. Uranium had a big week, up 5%. The ags were mixed here. Precious metals all to the upside, as you can see, and the stocks led up 2%. And as far as the bond market, well, the 10-year, 30-year, so 10-year for the week was down slightly, but that still remains a concern for the market if that doesn't start to pull in. And the yield curve is now at 1.07, the ratio. So it's well over, it was inverted the longest in history. That has not been the case now. And next, item number 7 shows the economic news calendar. Right away on Monday, we have S&P Global PMI final. Again, there's a lot of different news here. FOMC minutes on Wednesday. Jobs report is this Friday. It wasn't last Friday. It was shifted to this Friday. So be aware of that. All right, guys, let's go and move to the charts here. So one thing I commented about is one positive for the market is these large cap tech stocks are still holding up very well. So here's a Meta. So you can see it did hold the critical support for now, this uptrend line around the 50-day moving average. Again, still well off the highs. It could still fail here from a lower high, but it did hold support for now. Right now, you got a resistance right around this 610 area. Chart number 9, here's Amazon. It's holding up very well, kind of a wedge-like pattern. So this still looks pretty decent. You got a little 3-wave pullback so far. In chart number 10, here's NVIDIA. So NVIDIA, as you know, bounced off that demand zone, which we had in place ahead of time. So we had this in place way back in November. So, our analysis has been perfect on this. From the coil back here, when it first broke the channel, we said that would be resistance, which it was. It came down to the demand zone. That was a good area to buy. So this still looks pretty decent. And chart number 11, here's Google. That still looks very strong. Okay, kind of coiling here, honestly. You can just get a little coil action there. And chart number 12, here's Microsoft. Now, Microsoft is the weaker of the large cap tech stocks. You can see it's below its 200-day moving average, 50-day, 9, 20. So it's weaker. It is holding this support for now, but that's the weaker one. Like I said, guys, this market is so damn concentrated. 10 of the largest caps tech stocks represent 30%. 36% of the weight in the S&P 500. That is just crazy to me. All right, let's go and move to the major indexes. So chart number 13, here's the Dow, or the chart showing the 5 major indexes. Like I said, nice correction since early December, especially on the Dow there and also on the equal weighted S&P. So Dow was down something like 12 days in a row. Hadn't happened since 1973. It's bounced around here a little bit, but it's still weak. It's right below its 9 EMA. All these are still below their 9 EMA. The NASDAQ here is slightly above it, but, you can see bouncing off the Bollinger Bands at recent low. We'll see if that can hold or not. Chart number 14, here's the Dow Jones. Again, it's only 30 stocks. We don't show this index too often, but like I said, we had actually... this was more than 10 days down in a row. Went into this demand zone. We were expecting a bounce, which we got. That bounce, like I said, failed at the breakdown area. 50-day moving average, the back test of the channel. It came down to the demand zone again. Now, we'll see. Can it hold here and go back up, or does this correction need more to it? All right. If it needs more to, we take out the recent low. That 200-day moving average could be a target. Moving on to the S&P 500, so chart number 15, here's the monthly view of the S&P. Again, this is the macro view. Like I said, we had that secular bear market from 2000 to 2008, and then we've been in a secular bull market since the March 2009 bottom, almost 16 years now up. So no changes here. We remain in this clean uptrend channel. There's no MACD divergence or anything. Usually your bear markets start, guys, whenever your MACD, you either have a little divergence or your MACD starts to cross on a monthly, like you can see back here. And you can see the MACD is still very separated. So any good pullback here, I would still view it as maybe a fourth wave pullback in the bull market. So it doesn't look like the end of this, bull market anytime soon. Next, chart number 16, here's a weekly view of the S&P, which again lost about 0.5%. You can see it's been testing this demand zones now twice in a row, so that's your support. You got the uptrend channel here. Like I said, we have this MACD divergence that had been developing here for many months. Hasn't yet really produced much pullbacks. We're still in the channel. I am expecting some sort of correction here in 2025. If this correction deepens, maybe we get it now or maybe we get it later, but I am expecting something sometime this year. Chart number 17, here's another weekly view of the S&P. Just a very simple analysis. This uses the 89-week moving average. If you know your fibs, that's a fib number. And, it tends to only get too far away from that 89-week before you need to retest it. And we've gotten quite far away from it here. So I'm just wondering eventually if we need to, revert back to the mean sometime. And finally, chart number 18, here's the other weekly chart. So this is what I've been referring to for a while. Should this correction deepen and it be a larger fourth wave correction, this could be some of the targets down to the 23.6 fib to the 38% fib. I mean, it could be to 5,500 to 5,100, 500 to 900 points. Again, would still be a bull market, guys, but it would be a larger fourth wave. So we'll see. Do we get that now or do we get it later? We'll see. You can see the coiling action here in the RSI indicators as well. So that's your macro views, guys. Moving on, chart number 19, here's the KISS systems. Now, these are the KISS systems on the weekly indexes. No changes. They're all still long here. The weekly KISS systems have been long since essentially early 2023, as you can see. They have They employ wider stops because they're weekly charts. They're more like paint dry systems. Those of you who maybe hardly want to do any trading, you want to mostly ride the markets, that's what they're good at. Next, chart number 20, here's the daily KISS system, S&P. So this is a little more adaptive than the weekly. It did get out a couple weeks ago, went to cash at roughly 59.50. It is still in cash at the moment. Okay. Chart number 21, here's the 4 time frames. Like here's the daily on the upper left. We're still holding that ATR and that see the support cycle dots where we bounced. We're below the ATR on all the lower time frames, so the bulls need to reclaim that. And let's move to the standard chart. So chart number 22, here's a very clean daily S&P 500 chart. So we remember, after we broke down from that shelf support in mid-December, boom, we said that rally would stall at the first test of that breakdown area, which it did. Exactly. That was probably the easiest short I've seen in a long time. Textbook. So we had a little double bottom here, and we bounced on Friday. Now, couple things here, guys. Like I said, we're in the middle of the range here, right? We did hold support, but we have an open gap here. The S&P likes to fill those gaps, all right? And if we were to fill that and weaken, you have that 200-day moving average down here that could be a target over time. That would be on that deeper wave 4 correction, okay? Otherwise, again, bulls could still possibly make another high here, but, they got work to do. Any pullback here needs to form a higher low. So, again, we're in between resistance and support. Chart number 23, here's another daily chart of the S&P. Been showing this channel and this kind of like head and shoulder look to it. A lot of people, too many people, when they spot head and shoulder patterns, they don't play out. Doesn't mean it's not going to play out. It's still possible. We did bounce around the critical support area here around this channel line for now. We're back testing the 50-day moving average. We have that open gap. We'll see. Can bulls rally and make another high here, or is this going to fail and go down? Fill that gap, and your larger support zone is back here around 56.50 to 56.60. It's a range. You can see this was important previous resistance, turn support twice. So this is a big level here, guys. So if we lose this area, I think at minimum we fall down to here and test that 200-day moving average. Okay. So we'll see. Bulls got their work cut out. They got to build on this bounce and not take out the recent low. And chart number 24, here's yet another view, just a very simple kind of an expanded coil-like pattern that would allow for another move to a new high here, because you would have a wave A, B, a move up, and would be a wave C. Okay, so that's another possibility. Next, chart number 25, here's a 60-minute view. This is the one I just discussed in the opening part of the newsletter. Like I said, we had that perfect one-to-one symmetry bounce into resistance, sold back down, double bottom, rallied up. We got a big fib confluence area at 59.66. That's a big important level there. If we can exceed that and hold that, that would be a positive. Then you get a gap up here. We got a gap to the downside too if we start selling off again. Chart number 26, here's a 60-minute chart, another one. So like I said, shows you the same thing, the breakdown from that shelf support. And you can see here, like I said, I could see either a follow-through rally or pullback, higher low, rally again, or we just dump. Okay, both options. And chart number 27, here is a 15-minute view of the S&P, just showing how we held that support demand zone. Basically like a double bottom, essentially. There's a little resistance right here at 59.50. So there you go, guys. We will see what happens. Oh, and chart number 28, here's SPXU. That's the triple inverse ETF. Just showing you this, guys, because if you remember, we said the S&P would find resistance at that previous breakdown area, which it did. If you took advantage and bought the inverse ETF down there, which was essentially the reverse, it was the demand zone, you had a heck of a trade. Hope you took some profits, though. Next, chart number 29, here's the Triple Q's NASDAQ High Performance KISS system. So this is still in cash, guys. It went long, recently found resistance at that ATR. Actually, this bounced. Looks like I need to update this chart, but it is still flat at the moment, the daily system. Chart number 30, here's the 4 time frames. Now on the daily here, notice we got a little support cycle. So that's a positive. We are below the ATR though. Below the ATR on all the time frames, so the bulls need to recover that. Notice we bounced off that support cycle on Friday. But again, we're below the ATR on all these time frames. We had a DeMark 13 on Thursday's low on the 130 minute, so we bounced from there. Chart 31, here's a weekly view of the triple Qs. Just similar to the S&P, it's been in this channel. One way to label this would be some wave 5 up here. Whether wave 5 is complete or not is too early to say. But that's your bigger term view. Chart 32, here's the daily view. Here you could see how we stalled at that parallel channel. I simply moved the channel down here. So you can see we bounced. We undercut the 50-day moving average last week slightly. There was a demand zone there where we bounced. Right, we did find support there. That was the area we needed to. The bullish view, you completed an ABC. All right, but again, we still have a lot of work to do. We got to clear the 20-day. We got to clear the downtrend line. If we fail here, if this comes down again, your next demand zone is right down in here, and then you have your 200-day moving average. Chart 33 is a 60-minute chart. I'm going to move away. I didn't update that. So let's go ahead and move finally to the Russell. So here's the Russell. This is the daily chart. So the Russell, as you know, had a nice breakout in October, November, but then it topped out. Big correction there. It's still chopping around here. You still have that 61 fib down there and 200-day moving average. But right now it's just chopping around. It's got a lot of work to do here. And chart 35, here's the 2-hour view. Now, the 2-hour view, it's really been holding this demand zone. You can see it's been tested here many times. Get a nice MACD divergence of that recent low. So this is trying to build a little base, so that is a positive for the market. If this can push up, you really don't have any resistance until you get to this 231 area. This big down candle here doesn't offer any resistance. Okay, so that does it for the major indexes, guys. Let's move on. Let's look at a few of these indicators. Here's the VIX. So the VIX, remember, gave us that buy signal a couple weeks ago when it was outside the Bollinger Bands and closed back inside. Had a nice trade. Right now it's basically right in the middle of the Bollinger Bands. Looking at a 60-minute chart, here's the 60-minute view of the VIX. Here I can see some sort of perhaps coiling action. Notice again, the VIX, as I always tell you guys, loves to fill these gaps, even more so than the S&P 500. Okay, and the indexes really love to fill those gaps. So we got a couple gaps here to the downside. So for the bulls, that's a positive. It may want to fill these gaps, and that would create more upside. Chart 38, here's the NYSE with one of these breadth indicators. Just showing you this because, a couple weeks ago, this was very oversold. In fact, this was more oversold than it had been in 2 years. So, so not surprised we bounced a little bit. Chart 39, here's the percentage of stocks in the S&P 500 that are trading above their 20-day EMA. I keep forgetting I got to fix this typo. ING it should be, not IND. Sorry about that. Anyway, remember this was in that very oversold range. Hadn't been this oversold since October 2023. But I said a lot of times it'll do like a double test where it will get oversold, bounce a little, and come down again like you see there. Well, that's exactly what happened this time. So that's also a positive for the bulls that maybe we can work up higher. And chart 40, here's just an example of that action. This is 2023. You can see how you had 2 of those little double tests of that oversold area, which were decent market bottoms. Chart 41, here's the BPSPX. That's the bullish percent S&P index. So you got a lot of things here. The breadth has been very negative this year with a very strong concentration in those large cap stocks. You can see it here, how the BPSPX was diverging down from October while the S&P made new highs. But otherwise, this is something you guys may or not be aware of, but this is standard divergence. This here is reverse divergence. So it's where you got a higher high on the price, a lower price on the indicator. And so notice all of these lows have had reverse divergence, including this one. You have it. So something to be aware of. That's potential positive. Chart 42. Here's a chart that still concerns me a bit. This is the S&P 500 versus the Indian Stock Exchange, Nifty 500. If you know your history back in the 60s, the U.S. had the Nifty 50. So this is the Nifty 500. Anyway, Two tend to move together. You can see the last time we had a big divergence was in late 2021. That then led to a bear market for the US market. Well, we have that divergence again with a lower high on the Indian exchange, higher high on the S&P from December. So is that telling us something this could be leading to a larger correction? Well, we'll see. Too early to tell. Moving on to the bond market, chart 43, here's the 10-year. Still continues to hold up here very strong. It's still above its 9 EMA. In fact, it could be flagging. You can see the last high pull back from that resistance, which we talked about. But should it take this out, then you got the next high there at the April highs. Big rally from that demand zone, which we had ahead of time. And you had your moving average ribbon pinch. If rates continue going up here, guys, that could start spooking the market a bit. Chart 44, here's the 10-year on the weekly, which was down 0.5% for the week. But man, guys, I had this weekly demand zone back here in July and August, and this played out perfectly, this ABC. And chart 45, here's the big picture chart going, back 44 years, 45 years to 1980. Like I said, the bigger picture, guys, is the secular bear market and the rates are over. They are now in a secular bull market, which they entered in after breaking out of this monthly 35-year channel. So, and chart 46, here's the yield curve. Like I said, the yield curve was inverted the longest in history here. All right, it is now at a ratio of 1.07. Again, to me, this is it's the best indicator of recession. So I don't care what the media says. A recession is coming. It is inevitable. Just we'll see when it comes. Chart 47, here's high yield corporate bonds. Now, one positive for the market is short term here, since this low in mid-December, they have been stronger than the market, and the market tends to follow them. Here's a 60-minute chart of both the S&P and high yield corporate. Again, you can see how high yield corporate's been stronger here since that recent low than the S&P, but it is into a little supply zone. Okay. All right, guys, moving to the next part of the newsletter, let's look at the market sectors. So here's XLK technology. Obviously, it's highly concentrated. Still in this wedge-like pattern. We had that little Pinocchio move where they ran stops. You got to be careful of that, guys, on patterns where they trick you and then reverse it. Still holding the wedge for now. Okay. Chart 50, here's the semiconductors. You got a beautiful coil here, so that's a positive. But you also have a diamond pattern inside the coil. So this, to me, I would be watching semiconductors, one of the more important sectors here, because this is set up for a big move up or down, and that'll affect the market. Chart 51, transports. They had a nice correction, as you know, all December, or since late November. So far, been holding around this 200-day moving average. Got quite oversold. Chart 52, here's financials. They had a little breakdown a few weeks back. Bounced near this demand zone. Still struggling here. You got the moving average. You got resistance of these two moving averages, the 20, 50-day. Chart 53, here's healthcare. This has really declined, actually, since September. Little bounce so far, little three-wave bounce, but still in a very strong downtrend. It is quite oversold, though. It's way below its 50-day, 200-day moving average now. Chart 54, here's consumer staples, XLP. It's right around its 200-day moving average, so we'll see if we can find some support there. Also a little RSI divergence. Chart 55, materials. This has also had a heck of a correction from the October highs. There's a bigger demand zone down here that could still be a magnet. There is some divergence setting up now, though, in the RSI. Your moving average ribbon is very wide, so it's getting quite oversold here. You can see the volume spikes, so we could be seeing some capitulation volume, perhaps. Chart 56, here's utilities. They've bounced back the last couple weeks as well. Chart 57, the home builders. Obviously, after this double top we pointed out, they've had a good correction. And the rally in rates yields have not helped this, obviously. Now, it is quite oversold. There is an open gap down here, but it's way below its 200-day moving average at this point. I'll say one positive is this 2-hour time frame. It's trying to build a little base here, nice divergence. But again, onus is on the bulls or the real estate agents, whatever. Chart 59, real estate, IYR. Also trying to bounce right around its 200-day moving average, but not the best bottoming pattern, but logical for it to find some support there. Jabber 60, XLE Industrials, nice correction as well. Getting close to that 200-day moving average. So you see my point, guys. A lot of these sectors have been absolutely killed, except for some of the tech stuff. So one hope for the market would be some of these beaten down sectors could start to bounce. Now, one area that I like is energy. Steve and I have been talking about this. Here's the weekly view of XLE Energy, bouncing off this big support demand zone. Looks like a very low risk area to be long with a fairly tight stop. Here's the daily chart. Remember I warned back here in November when it was at the top of that range? Well, I didn't know it was going to sell all the way to the bottom of the range, but got quite oversold there. That was a good area to take a shot long, and it's had a nice move. Jabber 63, here's oil services, also bouncing around this 200-week moving average. This is the weekly chart, by the way, and demand zone for now. Here's the daily chart. It's very choppy on the daily, so it's got a lot of work to do. Jabber 65, here's the bullish percent energy index. This is in the oversold region. Remember, this goes from 0 to 100%. So, it doesn't mean this can't get more oversold, but it's definitely low risk energy stocks down here than they were back here in April when they were in the overbought area. By the way, that's when the energy sector topped out, was in the overbought area. This is now in a lower risk area for swings. Some individual names. Here's Oxy. I've been pointing out this wedge since mid-December. Well, hopefully some of you guys bought that. Nice move so far. By the way, Buffett, that's his favorite energy stock. He bought more of that a few weeks back. It's had a nice move out of the wedge. Here's the symmetry target. That's the first target, but this could be longer term hold perhaps. It's had a nice correction from the April highs. Jabber 67, here's the weekly chart. We did bounce off this little area. Again, not completely sure it's totally bottomed yet. If we do get another sell-off, there's bigger supports down here. But it's nice to see that Buffett bought it. By the way, this area around 54.5 is resistance now. Jabber 66, CVX, Chevron. That's another one I think he owns. Buffett. You can see it's been in a range here for the last 3 years. So another lower risk one. And here's another one, guys. Tidewater. It's oil and gas equipment, I think. This has had a heck of a correction. This is a weekly chart, by the way, since May, July. So basically a 50% haircut there into a weekly demand zone. So to me, this looks like a low risk swing perhaps as well. Looking at some of these world markets, here's Argentina. Boy, this is a weekly chart. This has really screamed. And boy, what a stock market. And of course, their recent president, and he's very friendly and making some positive changes to their economy. Here's the daily chart, just moving up, up, up. Quite overbought here, but it's still very strong. And ARGT, that's the ETF. If you want to play it, still looks very strong. Now, the opposite to strength is Brazil. Look at Brazil. You essentially have this, parabolic downtrend. They have the opposite. They're basically going more socialized, and, well, stock markets don't like that. And here's emerging markets, EEM. Still hanging around this demand zone. Could be a low risk area to be long some, with a stop somewhere below that demand zone. So there you go. Moving on, let's look at the US dollar. Here's US dollar, which pulled back on Friday, but had a big up day on Thursday. There is some active divergence here, but this has had one hell of a rally since this falling wedge low that we talked about back in September. So it's still very strong. We need to see a reversal sometime on the dollar to help the markets. Jabber 76, here's Bitcoin. Remember Bitcoin, our target was 100,000, especially after breaking this trend line back here in October. That was a great area to go long. So it did break 100,000 a couple times here, but you had formed a nice divergence here. You can see the little three tops. Then we pulled back. Now there's a demand zone. It's holding that for now. Okay. It needs to hold this area. If it doesn't hold this area, though, there's really no support here until you get down to this range. But for now, bounced off the demand zone. Chart 77, DBC, that's Commodities ETF, weekly view, up 1.9%. Remember, it's been in this range for 2 years. Energy is really building. You can see the coil here. Again, I think this is going to have possibly a big breakout in 2025. So that's a macro call of mine. Chart 678, here's the monthly view. You can see the monthly moving average ribbon's really starting to pinch now. You can see the volume is really tapered off. MACD is recycled nicely back near zero. It's trying to curl a little bit. Still may need some time, but this is setting up to a big move, guys. Chart 79, here's DBC on the daily. Broke out of that little small coil. Little pullback on Friday around the 200-day moving average. Now, one thing that interests me for commodities this year are the ratios. Here's the CRB SPY ratio, just an absolute beautiful wedge with divergence. I showed that last year. Well, it broke out of there as commodities have been outperforming the S&P. Now, if this continues, that could spell more weakness for our general markets. So this is definitely would be a concern of mine for the general market. Chart 81, here's the DBC SPY ratio. That's the daily. Okay, those are the two ETFs. You can see the wedge here. One way, if you think this wedge is going to continue to play out, guys, one way to play it would be as a pair trade where you go long DBC and equivalent short SPY. Or, you could put a more of a stronger weighting on DBC, but you could do a pair trade. Next, chart 82, here's crude oil. Remember, it had this little coil in this larger channel. Broke out of the coil last week. Finally breaking this channel a little bit, so crude looks pretty good. Here's the weekly view of crude, which is up 4.75% for the week. Okay, it's been kind of forming this wedge for the last year and a half. Chart 84, UNG natural gas. So remember, UNG has been struggling around this 200-day moving average for the last year and a half. Finally broke it, held that 200-day. Then it had a huge pop on the weather. Okay, hope you sold that. It's now pulled back. Now, that said, this area could be an area to watch for another long because I would think it could maybe find support back around one of these moving averages. Here's the zoomed in daily. So like I said, 200-day moving average all the way to the 20, 50-day would be a support zone. You might want to look at an intraday chart, see if you can get a trigger for a new long. And chart 86, here's copper. Little bounce on Friday, but it has been downtrending and it's been definitely quite weak. Maybe a little indication of global weakness, especially China, which uses the most copper. So that could maybe fuel recession concerns down the road. Chart 87, here's DBA. Agriculture is still quite strong. Little ABC pullbacks trying to move up again. One of the areas to watch, guys, again, is uranium. Here's URA up 5.4% for the week. Remember, it started its bull market back in 2020, and I've been bullish on it since then if you go back and listen to my newsletters. Had a nice little correction this year from that head and shoulder, but held that uptrend line, 200-week moving average. So far, we got a three-wave ABC pullback, which could have completed that correction. Here's the bigger picture monthly view. Like I said, it had formed a Weinstein multi-year base, broke out in 2020. That's when I became bullish, and still uptrending. One of my targets are up here at 40 to 45 bucks. Here's the daily URA chart. Again, big pop last couple days. I would also look at some of the other uranium stocks. I don't have them here listed, but they will move in concert. Chart 91, here's palladium, weekly view. So palladium initially had a nice rally off the support, stalled at that supply zone back in October. It's pulled all the way back. So now it's back into this demand zone. Will it hold here? We'll see. All right, moving average ribbon's getting a little more pinched here. It wasn't able to go positive there, but they are quite pinched. So let's keep an eye on that this year. Moving to precious metals, chart 92, here's gold. Weekly view up 0.9%. Remember, Knight had a big breakout early in the year in February, March from this nice multi-year base. To me, we've been counting this as a fourth wave correction. Whether this fourth wave is done, it still may need more time. But then I'm expecting new all-time highs. Chart 93, here's the monthly view. Like I said, I am expecting new all-time highs once this fourth wave correction is over. I'm expecting over $3,000 an ounce. But again, this still may need time to work off because it's had quite a move here. Ribbon got pretty wide. RSI's got pretty overbought. So, look how far your MACD got. That's why it wouldn't shock me if this needed to go through even maybe another couple months of consolidation. We'll see. And here's the daily chart of gold. Like I said, there's multiple versions here, as I stated, from December 21st. An ABC zigzag, which if we get that, we would make a new low here, at least down to the 200-day moving average. 200-day moving average is always a good area to buy some gold. Or you get a less deep correction, you get more of a coil, which you could see we did bounce off of that, so it is possible. It would be A, B, C, D, E. So I'd expect, if the coil is forming, I'd expect this bounce to fail ultimately, then come down again into E. But again, we'll see, guys. And here's the ETF GLD, shows you the same pattern. Chart 96, here's the other daily chart of gold. Again, talks about this, that reviewed that high in October as a wave 5 of 3. We're viewing this as a wave 4. And again, that may need some time to unfold. Next, chart 97, here's silver, which has been consolidating here. Now it's back above its 200-day moving average again. You can see it's trying to find support in the demand zone. Your bigger support zone is down here around the 2630 area, 2620 area. So you can see it was previous resistance, support. I don't know if we're going to get down to there, but that's a big area. If it got down to there, I'd be loading up on silver. And here's the big picture chart of silver going back to the 1970s. Like I said, it did stall at the supply zone on that last good rally last year and pulled off of it. But I do think if precious metals have another big run this year after its consolidation, that this silver may attack this 50 area. Remember, this was resistance in 2011, that blow-off move, and in 1980, when the Hunt brothers tried to corner silver. They were essentially channeling the Trading Places movie. Maybe that's where they got some of their ideas from. They cornered the silver market and they got absolutely destroyed. But I think that area will be eventually tested again. Moving on to the mining stocks, here's GDX. So it did bounce back last week, up 2%, 2.2%. Chart 100, here's the bigger range on the weekly GDX. You can see the bottom there in 2022. Chart 101, here's the daily GDX. Again, so far, nice 3-wave ABC pullback. Didn't tag the 61 fib this time. It still could on a pullback, but it's had a nice correction from the October highs. And chart 102, here's the BPGDM. So this is down to around 39%. It's not down into deeply oversold territory, but it is working its way down. Excellent sell signal back here in October, as you know. This is a very clean system chart. Now, final part of the newsletter, guys, let's look at trade ideas. So OSS was one from last week. This kind of cup and handle look. Big move on Friday. Still looks pretty decent. Chart 104, GEV. One we posted late last week. Breaking out on Friday. I like how it held the 50-day moving average, breaking a trend line here. Look at your moving average rim. It is really pinched and trying to curl up. Here's Rocket Lab. Man, this has been one hell of a move. We had as long ideas way back here. The thing is, went up 400 or 500%. Had an ABC pullback there, and it now looks like it wants to rally again. Just amazing strength. Here's some new ones. Chart 106, CLS. Nice coil pattern. We like these coils. You can employ fairly tight stops at the coils, and they have strong moves. Chart 107, MXL. Another nice tight coil here. Chart 108, AI. The AI ChatGPT broke out from resistance. It's pulled back and retesting the area, finding support. This looks like a good low risk long with a stop, say, below this 50-day moving average. Chart 109, Kang. Big run up here recently. Here, again, you got a little resistance right here at 540. This isn't for the faint of heart, guys. It's quite volatile, so be careful with it. Chart 110, DRI. Nice little tight coil pattern. Resistance 189.20. Chart 111, IONQ. resistance here at 48.50. Again, this is at a hell of a run, guys. I mean, it's $10 back in September. It's now almost $50. So this isn't a swing at this point. At best, it may be a day trade or a quick trade. So just be aware of that. All right, guys, we'll see how futures open later on. I'm going to go outside and play with my kids, take them to a big hill. Again, thank you for all your support in Breakpoint trades in 2024. Looking forward to a great 2025 with our analysis, with our systems. And I appreciate all the support. Thank you, everyone. Have a good rest of your Sunday.